Banks and you. The Federal Reserve System was established on December 23, 1913, during the Woodrow Wilson administration. One of the practices that is regulated by the Fed is fractional reserve banking. The fractional reserve banking system requires that all member banks of the Federal Reserve set aside a fraction of each checkable deposit, whether the deposit was made by a consumer or a business. So, how is this presented visually for each bank? All banks have what is called a balance sheet or a T-chart in the fractional reserve banking system. It's called a balance sheet because there are both sides of the sheet and it must balance, and it's called the T-chart because, well, it's in the shape of the letter T. So let's look at our fictional bank, Big Money Bank. For all banks that participate in this banking system, they have two titles on the balance sheet. On your left, you have assets, and assets are resources that have value that can provide a future benefit. On the right, you have liabilities. Liabilities is a requirement to pay money in the future. So all banks have checking deposits or demand deposits under liabilities. And these are deposits made by businesses and individuals. So why would deposits be under liabilities? Well, at any moment, you can return to the bank and withdraw your deposit from the bank. But let's say you want to keep your deposit in the bank. With your deposit being represented on the right side, on the left side, you have required reserves, which are defined as the currency that banks hold in their vaults. Again, that amount is set by the Federal Reserve. Required reserves is also referred to as the reserve ratio because it represents the amount that banks must hold in their vault or send to the Fed by law. So the remaining amount from the deposit are referred to as excess reserves. These are reserves that are kept in the bank vault and can have multiple uses. We will focus on those excess reserves in a minute. But right now, let's look at how required reserves are calculated. So again, recall that each bank has what's called a balance sheet or a T-chart. And the reserve ratio formula is the commercial required reserves divided by the checkable deposit liabilities. So once again, let's look at Big Money Bank. And again, on your left side, you have assets. And on your right, you have liabilities. So let's say that a customer would like to deposit $5,000 into their checking account. And Big Money Bank are required to hold $500 from that $5,000 deposit. Well, you can determine the reserve ratio by placing the commercial required reserves, which is $500, and divide it by the checkable deposit liabilities, in this case, $5,000. And your answer would give you 0.1 or 10%. Therefore, 10% of each deposit into Big Money Bank must be held in the bank, regardless if that deposit was made by an individual or a business. So let's say we still have Big Money Bank, and with their balance sheet, a regular balance sheet would look somewhat like this. You have liabilities, and on your right side, you have deposits and owner's equity, or simply equity. Owner's equity represents the owner's share that they have invested in the bank. On the left side, you have once again your assets, required reserves, excess reserves, and your loans. So what happens if a bank decides that they do not want to keep all of their money in the bank? What if they decide to loan it out? Well, the loan amount would be placed here in the balance sheet. Banks also own what's called physical capital. Physical capital can be in the form of property, in the form of land, houses, building, or simply equipment. And securities. Securities is another word for bonds. And we're going to talk about the bond market in my next video dealing with the monetary system. So let's see how money is created with the fractional reserve banking system.